Well, Mike Wilson is back at it again, our famous bear with yet another bear piece. As usual, let's jump right into it. So, a weekly warm up from fear to greed, says Mike Wilson. Investor sentiment and positioning has turned 180 degrees at an inopportune time, in our view. Fading fiscal support, less liquidity, and the impact of inflation falling faster than expected contribute to second half of 2023 caution. Now, one of the things that he starts with is this idea that sentiment and positioning has turned outright bullish as both retail and institutional investor sentiment has reached its highest level in over 2 years. Now, I thought that was very interesting because just last week we went through the uh, Bank of America Fund Manager survey and Goldman Sachs positioning surveys and JP Morgan positioning surveys. And there's no indication that people are actually as bullishly positioned as Mike Wilson suggests. So I looked at, one of his charts for suggesting that people were so bullishly positioned, and I wanted to look into it a little bit. He uses this right here. These are the charts he uses. He uses sentiment and positioning are near post-pandemic highs. And I thought, really, because that's only what we've heard of recently, but people's positioning doesn't seem to be that high right now. In fact, people's positioning seems to be really low. So what I did is I researched this NAAIM survey, which I had never heard of before. And I thought to myself, okay, what is this NAAIM survey and what can it actually tell us about investor positioning? And this is what I found. It's an NAAIM exposure index. And what I thought was incredible was the following. The chart, or basically the survey, depicts a 2-week moving average of responses. And then I thought, okay, well, of what kind of responses? And it says here, as the name indicates, the exposure index provides insights into the actual adjustments active risk managers have made to their client accounts over the last 2 weeks. And then here's the similar chart that we saw from Mike Wilson's Morgan Stanley. And then I'm like, wait a minute. People are not positioned bullishly today. And as a result, as they've started missing the rally, they've realized that this last rally has legs. And so they've U-turned and they've rapidly U-turned their positioning. They haven't positioned heavily bullishly. In fact, the average fund manager is still 32% underweight equities. Most most institutional investors still have substantial cash or bonds or cash equivalents sitting on the sidelines. And so what Mike Wilson in his bear piece is saying is, well, or what he's trying to do is he's trying to say, hey, look, I mean, he says it here clearly. Let's just use his words. So now you have a little bit more background. And Mike Wilson is trying to tell you, hey, look, everyone all of a sudden is positioning themselves a lot more bullishly. Sentiment and positioning has turned outright bullish as both retail and institutional sentiment has reached the highest level in 2 years. But wait a minute. The survey chart that you're using is actually a survey chart that measures the change in positioning. It's a first derivative. Wait a minute. How do we reconcile that, Kevin? I failed math. I need to know a little bit more about what this means. Okay, so let me put it this way. Let's say you are a bear and you've been a bear for a long time. You're like, look, this is a chart. If I'm here, it means I'm a bull, okay? But I'm a bear. So I've been positioned down here for a long time. And it's like you're a bear, 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 bear. Well, if all of a sudden you're like, oh dang, maybe we need to be like TS Lombard. And because there's a risk that this rally continues and we don't want to be caught offside with horrible returns, let's increase our exposure to equities. And then all of a sudden you're like, we're going to be a little less bearish and we're going to go like neutral. Okay. And then we're kind of going to stay there. Well, that inflection point would show you a massive spike on a first derivative chart. A first derivative chart is very much like this chart that Mike Wilson is talking about right here. So when you get this NAAIM chart, you're really looking at the change, the rapid change of people's positioning. Now, that is very, very different from what Mike Wilson is implying here. Mike Wilson is implying that everyone's a bull now. No, people have just rapidly gone from really, really bearish to less bearish. And this is now what Mike Wilson is using to reiterate that fundamental growth is about to get destroyed. And again, I'm not arguing that there aren't going to be stocks that are going to correct and that there aren't stocks that are overvalued. But to make this argument that, oh my gosh, everybody's bullish and this chart is at the highest level in 2 years without actually understanding that this is a first derivative chart is ludicrous. So, to explain it like somebody's 5 years old, somebody was really, really sad. Then they got a cookie. And while overall they were still sad, they became slightly less sad. And if we measured the change in their emotion from really, really sad to slightly less sad, we'd see a big spike. It would just be like, all of a sudden, this line went up. And if we measured how quickly that line went up, we'd be like, oh, that looks like a big change. The person went from being really, really sad to being less sad very rapidly because they have a cookie. And if we just looked at that little measurement of excitement and said, oh, now that person is a bull, we'd obviously be mischaracterizing them. Anyway, okay. So that's just the first part of Mike Wilson's piece here. Okay. What else? Inflation is falling fast. Now Mike Wilson is literally going for the argument as a bear that, folks, inflation is now falling so fast that crap, now earnings are really going to get hurt. This is bad because if inflation falls so fast, it means companies are going to be able to raise prices as much anymore. Duh. And it means their profits are going to go down. Duh. Especially staples. Yet, spoiler alert, what stocks does Mike Wilson suggest that you invest in? What is on Mike Wilson's fresh money buy list? Well, of course, the first thing that's on the fresh money buy list is access to Kevin's courses linked down below. Email us at staff@mekevin.com if you want a bundle. Check them out. Real estate, 0 to millionaire, stocks, and psychology of money. Things like perspectives, like you're learning here. Artificial intelligence, how to actually use it to be more productive in the productivity course on making more money as an employee or an entrepreneur. Liability, insurance, LLCs, attorneys, dealing, all of this stuff. Incredible things we've got in there. Anyway, here's the fresh money buy list outside for Kevin's course. Hint. Anyway, what do we have here? Fresh money buy list. Coca-Cola, Colgate Palmolive, McDonald's, Mondelez, Humana, Verizon, Walmart. Oh no, the very staples that Kevin thinks are actually going to perform poorly because of a lack of the ability to raise prices under an inflationary regime, because they don't really have marginal pricing power beyond just people buying some of these things out of necessity, which does not necessarily imply you can raise prices forever. That's exactly why we're seeing limits to price increases talked about at Coca-Cola, at Costco, at Walmart, at Target, at Kimberly-Clark. They're all like, crap, we can't raise prices anymore. Because, oh my gosh, even though because you're a staple doesn't mean you can raise prices forever. Imagine that. There's actually a limit. Wait a minute. So Mike Wilson says inflation's falling rapidly. And so to protect yourself from now inflation falling rapidly, you should invest in the consumer staples. But those are the ones with literally the smallest pricing power compared to some of the actual companies that are really going to have growth, like, the big 7 in the S&P 500, whether that's your Nvidia, your Microsofts, your Apple, or whatever. When they've already been at flat growth, year over year coming out of these stimulus eras, but at least you'll have some growth and some pricing power, unlike these staples, which is ironically exactly what Mike Wilson suggests you invest in. I don't know, blows my mind, but whatever. As a result of the weak arguments that Mike Wilson has for this, which is a lie, basically, the implication is a lie, and as a result of this inflation nonsense, now you have Mr. Mike Wilson suggesting the following. Fiscal support is fading. We're going from stimulus to not stimulus, and that's going to be bad. Really? Oh my gosh, Mike Wilson. I'm just going to leave that one and then just not add commentary to that one. Instead, let's go to the classic bear narrative. Yes, let's go to the classic bear narrative that every bear is talking about today. That's okay. But the classic bear narrative is the liquidity drain. The next 6 months is going to be so bad as liquidity starts getting drained, and it's going to destroy asset prices, especially stocks. Because that money's got to come from somewhere, right? Oh no, the money's got to come from somewhere. Well, where does it generally come from? Uh, well, as of late, the reverse repo facility. But wait a minute, Kevin. What indication do we have that during the last of the liquidity drawdown, money has actually come out of the reverse repo facility? Well, first of all, consider that when the Treasury General account needs to get filled up and they're offering you 5.6% on 6 month T bills, and the reverse repo facility is only offering you 5%, which that wedge gets bigger when the Fed pauses or cuts rates. Maybe all the money that's in reverse repos can slowly go help prop up the liquidity at the Treasury General account. Oh, maybe there's a chart that says exactly that is happening. Oh, maybe, just maybe, if we happen to zoom in a little bit, we can actually see that drawdown, just like we saw during the banking crisis, in the reverse repo facility starting to accelerate, which doesn't actually affect the stock market because this is like a massive insulative blanket of liquidity of $2 trillion, still $2 trillion sloshing around as of Friday. Oh, but it's starting to fall. Duh, that's what it's there for. I'm sorry. I'm just I'm just exhausted by the bear narratives that are weak. I mean, if they had a really good bear narrative here, I'd like to talk about it, but it's just weak. And then, of course, buried into the piece, what do you get? You get stuff like this. We do acknowledge that growth has been better in some areas than we would have expected at this point. More specifically, consumer services and certain technology spending related to artificial intelligence have surprised to the upside, at least for some companies. This upside has been reflected in both stock prices and analyst expectations in many cases. However, we would push back on the idea that this is going to drive a change in the growth trajectory for the entire stock market. Yep, don't worry, folks. AI is just a fad. Okay. So that gives you a little bit of a look into Mike Wilson here and some of his latest theses. As you can tell, I'm a little bearish on the bear. Anyway, okay, that covers Mike Wilson. Check out the programs link down below on Building Your Wealth. And let's move on.